What is going on, guys? Nick here, back with another video. A few years ago, I realized something that was so obvious, so simple, so basic, that I thought that, yeah, there's no way it could be that easy. But what I found became one of the easiest strategies to beat the market long term. Now, this is a simplified version of what I do on this channel, and if you had followed every single buy recommendation that I've made on this channel, you'd be beating the market by 8%. So here's what I realized. When most people talk about if a stock is cheap or overpriced, they tend to rely on the PE ratios. For example, here's a question somebody asked on Quora. Why do people buy Amazon shares even though it has a terrible PE? And some poor guy who apparently had been at it investing for the past 30 years said that he sold 40% of his Amazon position when it dropped below 900 per share. 900. Had this poor guy held, he'd be up 266% since April 2017 when this was written. Now here's a different article from Investopedia, also from 2018, saying that Verizon stock is very cheap with a PE ratio of 7. But Verizon stock has only traded sideways since then. So in Amazon's case, they had a high PE and the stock ended up rising. In Verizon's case, the stock had a really low PE, but the stock didn't go up, which kind of makes PE ratios seem really confusing since low PE ratios are supposed to represent undervalued stocks and high PE ratios are supposed to represent overvalued stocks. But what if I told you that these guys are looking at the wrong PE ratio? Both of these people are looking at Amazon and Verizon's trailing PE ratio. And now don't get me wrong, this is a very important number to pay attention to, but it will not give you the whole picture. So what I realized was this. I used to use the Yahoo Finance portfolio tracker site just to lazily see how my stocks were doing for the day without having to pull out my phone. It did have a lot of really cool information like the day chart and the price change, and even how much the stock earned over the last year. But what I also noticed is it had the trailing PE ratio, which at the time I knew was a great indicator of the stock's value. But I realized there was also something called the forward PE ratio. Now there is a lot of really obnoxious and wrong information that analysts put out there. For example, price targets, in my opinion, only seem to react to whatever direction the stock has been moving in recently, or buy, sell, or hold rankings that pretty much always seem to say buy no matter what. But if you've been in the stock market long enough to go through at least a few earnings cycles, you probably realize that earnings forecasts on stocks tend to be pretty accurate, maybe even slightly below the results most of the time. Now, forward PE ratios are the current stock price divided by the earnings forecast by the end of next year. So right now that would be 2022 or 2023. So what I realized was this. If I know what a stock's PE should be, and I just look for stocks with a lower forward PE ratio than what the stock should be worth, then if I just wait for the company's earnings to rise, the stock price has to go up. But there's no way it could be that easy, right? Well, you're right. It's not entirely. You still have to research the company and make sure that they're a solid investment. It is your money, so make sure that you read the news and figure out what's going on with the company first. Don't just blindly buy low forward PE ratio stocks. So how do you figure out what PE ratio the stock should trade for? Well, the way I do it is with a PE calculator that I made, which uses my estimates of the company's growth going forward to correlate what PE ratio the stock should trade for. If you do want to try it out, you can find it for free in the Google Sheet linked in the description. But if you don't want to rely on some random YouTuber's formula, pull up the stock on macrotrends.net and look at what the stock has historically traded at. For example, let's take a look at Visa. So this chart actually goes all the way back to 2008 all the way up till today. We have three charts here. The stock price is at the top, the earnings are in the middle, and the PE ratio is at the bottom. You can scroll over this chart and you can see how the stock price and earnings all work together. But if we scroll through the PE ratio, it seems like the stock generally trades between a PE of 30 to 45. Well, when we go over to Yahoo Finance, we can see that the stock is trading at a forward PE ratio of 25, which is well below what it usually trades at. So to me, this would seem like an undervalued stock. Now to take this all a little further, Yahoo gives us some great info on the analysis tab. It tells us how many analysts rated the stock and their average earnings estimate for 2023, which right now is sitting at $8.41. So if Visa were to go up to at least the low end PE ratio that it usually trades at, that would mean that the stock should trade at $250 by at least 2023. And if the stock goes all the way up to the high end PE ratio of 40 just to be on the safe side, it could go all the way up to $336 per share or 57% higher than today's share price of $214. Lastly, the stock market has gone up by 10 to 20% each year, so a company like Visa with a possible 57% upside seems like a pretty good bet to me. But moving on, now to give you a little bit of caution before you go all in on the strategy. The first thing is rate hikes are coming most likely in 2022. Now this isn't a huge concern though, since it's only going to go up by about 0.25% 4 times this year. But when interest rates do go up, bonds become more attractive investments, and that decreases some demand for stocks, which means that lower PE ratios ratios should occur. I also would avoid this on penny stocks or any other company that's really hard to get information on. While analysts do tend to be pretty good, I think smaller unknown companies tend to have less reliable information and seem to miss earnings more often. And last but not least, I'm saying it again, you do really need to make sure that you look into the business and make sure you're buying a good quality company. And an even better strategy is to just stick to companies that you really know and you really like. Not only does it become easier to follow the news and what's going on with the company, but it also feels pretty good to make money on a stock with a company that you actually really like. Okay, now to recap. Step 1 is look for stocks with a much lower forward PE ratio than the trailing PE ratio. Step 2 is to figure out what the PE ratio for the stock should be, and then see if the forward PE ratio is much lower than what the company should be worth. Step 3 is do your background research on this company and make sure that it actually seems worthy of investing in. And then step 4 is to buy and be patient. Watch the company's earnings come out over the next year and make sure that it actually stays on track to meet that forecasted earnings per share and that it's not missing its earnings expectations. So if you just follow these steps, I think you'd be surprised just how easy it is to find stocks with high upside and very safe floors. You really don't have to risk it all to get high growth with speculative companies that haven't actually recorded any sales yet. You should be able to do this very effectively with just blue chip companies. Now before you go, make sure you check out this video I have right here where I've actually done a lot of this work for you with the 7 stocks that I recommend buying in 2022. And as always, thanks for watching.